Hello friends, so let's begin our today's session, and we are together for ICWA final paper 20A, that is strategic performance management and business valuations, in short called as Spm&Bv. So myself CACS Pushkaraj Vishnu Joshi, and we are together understanding the whole topic, and I am helping you to understand the subject, and as we are along together for the entire syllabus. In today's session, I will be taking up, in the previous session we finished chapter 7, 7.4, and thereby we finished the module 7 also. Today we will start with module 8, which is about valuation of section B, which is about valuation of assets and liabilities. So it's a, if you see the percentage wise, it's a 15% weightage that has been given by the institute for this particular module, and in this module there are almost 8 chapters. So each and every chapter I will be taking you through elaborately. So as you know, for the this session series purposes, I have restricted myself to the, and as rather told by the institute also, I have restricted myself to the study material that has been provided by the institute, and it's a classic material again. And while covering the topic in this session and the PPT presentation that I am going to flash, as a matter of practice, the entire chapter I have tried to summarize it in a concise way, in a crispy way, and more from the examination perspective preparation wise, so that it becomes a handy note also for you for theoretical preparations of the chapter. Problems as such we will have to solve it as you go along with the study material study and revisions, etc. So I am trying to cover the entire syllabus in terms of theoretical aspects out over here. So let's begin. The first chapter is about valuation of plant and machinery. So as we know, each and every asset has its own peculiarities and needs to be considered accordingly while doing the valuation of that respective asset, whether it's the valuation being done for a particular asset itself, or whether the valuation is being done for the entire corporate or equity or business per se. So each asset has to be dealt with the different valuation methods and mechanisms because of the peculiarity of the assets. So various assets in a way we are going to look in this chapter, and that's why the title is valuation of assets and liabilities also. So if you see the 8th chapter, which is about valuation of liabilities, so how liabilities also are to be valued, we will see that. So to begin with, in today's session I will be covering valuation of plant and machinery. So again, as I said, I have referred to the study material only. So definition of plant and equipment or machinery, at times called as, is defined under the chapter, and to be precisely, tangible assets excluding realty held for production or supply of goods and services, or for rental purposes or for administrative use, and such assets is expected to be used over time, in short, not for shorter term or shorter duration, that is classified as a plant and equipment. Typically under plant and machinery, the various categories of assets that come are plant, that is combined assets, example specialized buildings and machinery. And machinery means individual machines or collections of machines used in operations or in the plant, and equipment typically includes other operational support assets to the machinery per plant and machinery per se. So this is how the 3 categories typically are covered under plant and machinery as such, or plant and equipment. So for this IFRS, that is IAS 16 has been prescribed, wherein definition of property, plant and equipment has been given. In a way summarized to be tangible items used for production, rental or admin purposes, and whose expected usage is over multiple accounting periods and not in the just in the same accounting period. So if the usage of that particular tangible item is going to be more than one single accounting period, then it is considered to be a property, plant and equipment as such. So valuation standards and considerations. So valuation standards per se includes fair market value or fair value, that is ASC 820, and fair value statutory. So machinery and equipment M&E valuations consider installation cost, often significant. The methods of valuation includes cost approach. So there are three approaches that are basis which the valuation can be considered for plant and machinery. First is a cost approach. Over here it is considered that based on substitution principle, cost to replace a particular asset will be considered as the value of that particular plant and machinery. However, it is adjusted for depreciation, physical, functional and economic also, and common starting point for asset appraisal. So typically cost is the starting point for asset appraisal. Second approach, second method of valuation is the direct market. So over here sales comparison approach is being followed. So in this uses prices of comparable assets in the used market. So in short, if there is a used market for that kind of assets or plant and machinery, then what is the price available for similar kind of a comparable asset will be the method of valuation. Again, it will be adjusted for the differences in condition, quality, location, age, utility, etc. So at times the qualitative aspects and qualitative factors have to be accordingly measured also, and therefore adjustment will have to be done for differences in condition, location, age and utility, etc. Income approach, so third approach which is used for as method of valuation is based on income generation potential, less common for individual machinery and equipment assets, includes direct capitalization which is income divided by capitalization rate, and second method is discounted cash flow wherein discounting projected cash flows is to be used. So this is how the income approach is considered for the valuation of plant and machinery. Then typically there are types of depreciation. So depreciation includes, so depreciation means where such kind of a event which in a way causes deterioration in the value of the asset or of plant and machinery. So there are prominently three types of depreciation. First is a physical deterioration. So typically it means wear and tear, environmental damages that or environment related damages that would happen to the plant and machinery, like rusting, you know, or what you can say, some kind of a chemical effect on the alloys that are being used in plant and machinery, or the raw material that is being used in the plant and machinery. So the environment has an impact, chemical impact on the plant and machinery also. So that is considered to be physical deterioration. And usage over a period of time, because a particular asset or plant and machinery is used for a continuous period at a higher frequency of time and for longer duration of time also, and therefore the usage also causes a physical deterioration in the value of the asset, and that's called as physical depreciation or deterioration. Second is the functional obsolescence. So because of the technological advancements or new aspects that are required to be adopted in the production, in a way there may be some kind of a functional obsolescence that may occur, which may cause the asset to be redundant to use. So in a way outdated design or inefficiency also is another class of another type of depreciation that is called as functional obsolescence. And third is the economic obsolescence, where external economic or regulatory factors impact and causes the depreciation. In short, the classic example would be motor vehicles. So for motor vehicles, typically now because of the economic obsolescence, economically maybe the government has come up with a rule that slowly over a period of time all the fuel driven automobile will be phased out, and slowly the convergence has to happen from fuel driven vehicles to energy saving vehicles or electric vehicles for that matter. So that's how it is economic obsolescence, whereby external economic or regulatory factors in a way are impacting and causing depreciation in the asset or plant and machinery. So for example, illustration example, fair value calculation. Let's say how fair value calculation is to be done. Let's assume equipment purchase cost is rupees 4,71,974. So that is 6.5 years ago, and life is of 13 years. So index at purchase was 254 and current index is 317. So replacement cost would be 589.06. 038, that is the index cost. Depreciation, if at all, is to be calculated, then on straight line basis, with 5% scrap, it would amount to 2,79,793, and therefore the fair value is in a way 5,89,038 minus 279,793. So that's how the fair value is calculated in a way. I'll show you example also in a way in Excel. Let's do it in Excel in a way. So let's say the 470 on 974. So 471 974 is the asset, and that was like when the purchase was happened was the index was at 254 and 317. So at that point in time it was 254 the purchase price, now it is 317. So the replacement cost would be, assuming so 317 into this divided by 254. So 589,038. So that's what the figure is over here. So in short, 471 974 into 317, that is the current index, divided by the index at the time of purchase. So on that, let's say depreciation 279.5%. On straight line basis, so for 6.5 years in a way, the depreciation turns out to be 279,973. So therefore the difference is 589,038 minus 279,793. 279,793. Hello. Speaking. Yeah. So I'm in a meeting actually. Can you call after 7? Yeah. Thanks. Thanks. So 309245. Yeah, precisely. So this is how the calculation is to be done, and that's what the fair value calculation is in a way. So I thought I'll just demonstrate how the calculation is to be done of fair value. So in short, fair value is that when the equipment was purchased, say 6 years back, 6.5 years back, it was 100 rupees was worth 254. But now while as on date, if at all it has to be scrapped and sold, then what is the fair value? And in that case it will be indexed as per the current index. So in a way that 100 rupees now 100 rupees were 254 when the purchase happened, and as on date it is like worth of 317. and therefore the replacement cost is the index cost, and from that index cost the depreciation has been reduced, and therefore the fair value turns out to be 309245. That's called as fair valuation or fair value calculation. So moving ahead, in a way the chapter ends over here. As I said, the entire module is going to be of each and every asset, and at the most every chapter is like a short chapter, and therefore with this the conclusion is that accurate valuation depends on appropriate standard and approach, consideration of all depreciation forms, and judgment of a qualified and independent valuer. The whole purpose of such valuation of plant and machinery is to deliver a well supported credible opinion of the asset value. So that's the purpose of valuation of plant and machinery. Now, as a matter of practice, I have been covering the short question and answer at the concepts that has been discussed in the short question and answer as well as long question and answer. So I am elaborately now taking up the short question answer, which is discussed after the chapter 8.1, and in the first short question and answer, the concept or the question was explain the three standards of value, that is fair market value, fair value ASC, and fair value statutory. How does the valuer determine which standard to use? So that, let's see what was discussed in that short question answer number 1. So in short, fair market value is the price agreed upon in an open market between the willing buyer and seller. Fair value as per ASC 820 is the exit price in an orderly transaction between market participants at the valuation date. And fair value statutory is the value defined by laws or regulations, often for legal or tax reporting purposes. So valuer's choice depends on the which of the three standards to be used, depends on the purpose of valuation, client's requirements, and applicable regulatory framework as well. So this is how the three standards are explained in, and the valuer will determine which standard to use, and that will determination will be depending on the purpose of valuation per se, the client's requirement for whom the valuation is being done by the valuer, and at the same time applicable regulatory framework which will supersede all the purpose and client's requirement also at times, and therefore applicable regulatory framework is also to be considered and factored into while determining the standard which is to be used. Then comes the second question, wherein the breakdown the three general approaches to value. How does the valuer decide which to use? So again, there are three approaches which we discussed in the presentation also. Cost approach, so it's a value based on the cost to construct or replace the asset minus depreciation. Second approach is the direct market or sales comparison approach, wherein based on the sales of similar assets the value is determined of a particular existing asset or asset in question. And third is the income approach, which is based on assets income generating potential. So how functional life of that particular asset is still existent, according to that whatever the future life is, accordingly the valuation is being done. So that's the third income approach. Now how does the valuer decide which to use? Again, the approach selection depends on the asset type, availability of data, uniqueness of the asset, and of course the valuation purpose, or rather why the valuation is being done. That will determine in a way for the valuer to decide which of the three approaches to use. Then in question number 3, short question and answer 3, illustrate how the cost approach is used for appraisals. Include an example. So typically formula wise, current replacement house cost is equal to purchase cost into current index divided by index at purchase. So precisely in the Excel example that we solved just now, this is the formula that we used. Sorry. So the current replacement cost is equal to purchase cost into current index divided by purchase index or index at the time of purchase. Depreciation is equal to replacement cost into 1 minus scrap value into age upon life. Fair value is equal to replacement cost. Example must be calculated by using real figures to test comprehension as such. So that's what has been discussed in the Question number 2. So this is how. Then comes question number short question and answer 4. In that, explain functional obsolescence and its impact. So what is meant by functional obsolescence? It refers to loss in asset value due to inefficiencies or outdated technology. And so because functionally they are obsolete or becoming obsolete because of the technological advancements, and secondly because of the inefficiency of the machinery also due to its aging. So in such scenario it becomes functionally obsolete, and secondly it reduces market appeal and usable value leading to lower valuation. So that's the impact that functional obsolescence has on the value of the assets, because in a way, because it's becoming functionally obsolete, the market appeal is not there, buyers are not going to be there, buyers are not going to get attracted to the that particular asset, and therefore the usable value in a way is turning out to be deteriorating, and hence it will always fetch a lower valuation. In short question answer number 5th, the point that is discuss economic obsolescence with an example. So economic obsolescence, as we know, is refers to external factors reducing asset value, example increased raw material or labor cost regulations, etc. can be the examples of economic obsolescence. Example wise, a new pollution law makes older machinery non-compliant and therefore decreasing its utility and value as such. So because of the environmental laws, maybe the plant and machinery which is emitting a lot of gases might have to be in a way put to shut down, and hence may be redundant to use, and therefore turning out to be economically obsolete, and therefore the valuation or the utility will always deteriorate or decrease. Then in short question and answer 6, the question which was discussed was which method is best for valuing unique machinery with no market competition. Why? So in such case where the valuation is being done of a unique machinery with no market comparison, the cost approach is most appropriate because it does not rely on comparable sales and estimates based on rebuild costs adjusted for depreciation. Question number 7 dealt with critically analyze the income approach for machinery and equipment valuation. Why is it least used? So basically it relies on assets income generating capacity or future income generating capacity, and not preferred therefore because attributing revenue to individual machines is very complex and at times not possible also. And thirdly, useful for cross-checking other methods when income data is traceable. So even if at all income data is traceable, income approach cannot be directly reliable. It has to be cross-verify with some other methods also and cross-check with some other methods also. So that's why typically the income, that's how critically analysis of the income approach for machinery and equipment valuation is done, and therefore it is least used because it's very difficult to estimate future potential earnings, and at the same time it is very difficult to attribute estimated future potential earnings to a particular plant and machinery as such. Then short question and answer number 8 has dealt with the question on identifying the 3 types of depreciation and their impact as such. So first was the physical deterioration, so which means wear and tear, and in a way it reduces the functional life. Second is, so this physical deterioration may be because of usage, because of passage of time, because of wear and tear, or because of environmental impact on that particular plant and machinery also, or maybe some chemical reactions because of the environmental impact. So that's how physical deterioration happens of a particular plant and machinery. Second type of depreciation and its impact is that functional obsolescence. So over here what happens, because of the technological or design inefficiency or design upgradations per se by the as per the need of the customers, that reduces the overall competitiveness of a particular plant and machinery. So in a way there could be change of preferences of the customers or the users of the particular plant and machinery, and over a period of time obviously the design inefficiency or is no more attractive also. At the same time, technologically also the plant and machinery more advanced would have come. So in short, if at all a particular example in individual's life one has to take, let's say if at all someone wants to buy a second-hand vehicle, again, why will he go when the market is now opening up with automatic vehicles and EVs? Why would one go for a second-hand vehicle from the used market also for a gear based vehicle? So that's how technological inefficiencies reduces the competitiveness and makes the asset functionally obsolete. Third type of depreciation is economic obsolescence. So economic obsolescence is the external economic factors which lowers the utility of a particular asset and therefore the demand of that particular asset, and hence resulting into lower valuation of that particular asset. So economic obsolescence means in a way such certain external factors which impacts the utilization of a particular assets which has been prominently being used by the business, but because of certain external factors that particular asset might not be more relevant now in the current times, and therefore it becomes economically obsolete also, and in such case that leads to a lower valuation of that particular asset. So these are the three types of depreciation which were discussed. Then in the chapter, below the chapter, there is a long question and answer which has been discussed. In that, the question number 1 is about appraising a machinery which is purchased for 10 lakhs 6 years ago, 15-year life, index at purchase was 100, current index is 154, 10% scrap value, calculate fair value. So how fair value will be calculated in this example? So stepwise explanation has been given. Replacement cost is equal to 10 lakh into 154 divided by 100, that is the current index divided by the index at the time of purchase. So that brings the replacement cost to amount of 15,40,000 less depreciable cost, that is 15,40,000 into 90% in a way, because 10% is the scrap value. So 90% in a way depreciation or deterioration has happened in the cost, and therefore in a way the depreciable cost is 15,40,000, that is the replacement cost, adjusted replacement cost into 90%. So 90% of 15,40,000 in 13,86,000. Therefore the accumulated depreciation is again 1,38,000. So 13,86,000 into 6 divided by 15 years. So 6 years of usage divided by 15 years of life. So that accumulated depreciation comes to 5,54,400. And this 5,54,400 is to be reduced from the replacement cost to arrive at the fair value. So fair value is equal to 15,40,000, that is step number 1, replacement cost minus accumulated depreciation, that is 5,54,400, and therefore the fair value calculation of this particular plant and machinery in the long question answer number 1 is 9,85,600. Then long answer summary, again long question which was asked in question number 2 was differentiate between physical deterioration, functional obsolescence and economic obsolescence. So this concept has been discussed in long question answer 2. So physical deterioration is wear and tear, aging or environmental related loss of value, and functional obsolescence means internal inefficiency, outdated design or lack of features. So in a way that's the second type of depreciation. And third is the economic obsolescence, wherein external market / economic factors reduces the asset utility, demand, and therefore value also. So these are the three types of distinctive or distinction between physical deterioration, functional obsolescence and economic obsolescence. Then short, long question answer 3 is discussed. In that, the concept that has been discussed is considerations when using direct market comparison for machinery and equipment valuation. So over here, because it's all about direct market comparison of a particular machinery or plant, the recent sales data has to be made available. So ensure that the data is up to date and recent and relevant and current, and of course market relevant. Then comes the asset comparability, obviously because it's about direct market comparison of a particular asset. So similar kind of a comparable asset should be found in the marketplace also, and therefore asset comparability will have to be done, and for that maybe at times adjustment for differences in age, utility and condition will have to be done. So that's the second consideration which is to be dealt with in direct market comparison. And third factor is the market activity, that is validate if there is an active or transparent secondary market per se for the asset that is being valued by way of direct market comparison. So that's these are the three considerations, especially the recent sales data, asset comparability, and third as market activity. So then in the chapter, after the concept, at the end of the chapter, the long question answer number 4 has discussed impact of functional obsolescence after new machinery installation. So what is the impact of functional obsolescence after new machinery installation has happened? So in a way, older equipment becomes redundant or needs to be shelved or scrapped also. The loss of utility or relevance leads to rapid devaluation, and likely non-usage further accelerates the reduction. So in short, if a new machinery is being installed, the functionally obsolete machinery that is because of which the new machinery is getting installed, the functional obsolete machinery will in a way become more and more redundant and useless, and will have to be shelved or scrapped also. Of course, the functionally obsolete machinery will lose its value, lose its utility, lose its relevance, which will lead to in a way rapid devaluation also. And third impact is that because of such likely non-usage, it will further accelerate the deterioration of that particular asset also. So these are the impacts of functional obsolescence after new machinery installation happens. Then question number 5th. Hello. Then question number 5th is about advantages and disadvantages of income approach in mergers and in machinery and equipment valuation. So first advantages are it reflects true earning potential of that particular machinery and equipment in an income approach, because that particular asset in a way would be capable enough to generate revenue, and therefore the income approach in machinery and equipment valuation first and foremost reflects the true earning potential of a machinery and equipment. Secondly, useful when machine income contribution is measurable. So again, this income approach is useful only when the contribution made by a particular individual machine is measured specifically and is quantifiable. Then only such potential earnings, true potential earning can be assessed, and then that potential earning in a way becomes the value for that machinery under income approach. The disadvantages, however, are that it is hard to link income to specific asset only, and there are involvement of complex assumptions about future income that is being forecasted and assumed to be potentially having capacity in that particular asset. Then long question and answer number 6 discussed the concept of proposed method to value diverse asset collection with varying lifespans. So if at all there is a collection or a group of assets which are there, and each diverse asset collection has varying lifespans, then how the valuation is to be, or what sort of valuation method should be adopted. So a stepwise answer over here is that step 1, categorize the assets by usage type and lifespan. So at least though they are diverse asset collection, but at least some kind of a Segregation either on the basis of usage type and lifespan has to be done. Second step would mean or would apply cost approach to estimate current replacement cost. So apply cost approach to estimate current replacement cost. Third step would be adjust each asset for physical depreciation based on age and usage, that is wear and tear. Functional obsolescence, wherein compared to the new technology, and economic obsolescence would mean market trends and cost also. So that to that extent the adjustment in the each asset will have to be done. The fourth step would be aggregate adjusted values to compute total collection value. So in short, these are the four steps or the proposed method to value diverse asset collection with varying lifespans. In a way, by following this proposed method, it ensures each factor impacting the value is accounted for systematically. So with this, we end the chapter per se. There are no more concepts that are there in the chapter per se. And hence, before ending the session, let's have a recap, which has been my practice. So we started off with section B, module 8, and the opening chapter was about valuation of plant and machinery. Again, as I said, it's a very small chapter wherein plant and machinery, how is to be identified, how the valuation methods have to be found, what sort of approach should be adopted, etc. is discussed in this chapter. So first and foremost, what are meant by plant and machinery has been defined. So definition of plant and equipment includes tangible assets but excludes realty which are held, and now such tangible assets should be held for production or supply of goods or services. Again, or it can be rental, used for rental purposes also. And thirdly, there could be some administrative usage of those assets. Of course, such plant and equipment are expected to be used over a period of time and in a way not short time. So in short, the usage has to be more than one accounting period, and then it gets classified as a tangible asset. The categories of plant and equipment includes plant, which means combined asset, that is specialized buildings and machinery also. Second is machinery, which means individual machines or collections used in operations per se. And third is the equipment, which are other operational support assets. Then IFRS IAS 16 has defined plant, property and equipment also to be tangible items used for production, rental or administration purposes and expected usage over multiple accounting periods. The valuation standards and considerations typically that are used as valuation standard wise, it's a fair market value or fair value as per ASC 820 or fair value as defined by statute. So machinery and equipment valuations consider installation cost often significant. So methods of valuation, there are three types of methods of valuation: cost approach, direct market, that is sales comparison approach, and third is the income approach. Now let's see, we saw one by one. Cost approach means based on substitution principle, the cost to replace the asset, adjusted for depreciation, especially physical, functional and economic. And thirdly, common starting point for asset appraisal as such is the cost approach. Second approach is the direct market sales comparison approach, wherein this approach uses prices of comparable assets in the used market, adjusted for differences in condition, location, age, utility, etc. And third approach is the income approach, which is based on income generation potential of a particular plant and machinery, and therefore less, but however it has to be reduced, less common for individual machinery and equipment assets. Includes direct capitalization, that is income divided by capitalization rate, and secondly is the discounted cash flow, which is DCF, which means typically discounting the projected cash flows of the business or the asset. The types of depreciation includes three types: physical deterioration, which means wear and tear, environmental impact and usage also; functional obsolescence, which means outdated design or inefficiency; And economic obsolescence means external economic or regulatory factors. Then we saw one illustration example of how fair value calculation is to be done. In that, the equipment purchase cost was 471,974 6.5 years ago. Lifespan is of 13 years. So index at purchase 254. Current index is 317. So replacement cost was 5,89,000, which was arrived by 4,71,974 into 317, which is the current index divided by the index at the time of purchase. That is 254. And thereafter the depreciation is reduced. So depreciation is straight line basis. So 6.5 years divided by 13. So in a way, the depreciation that is calculated out here is 479, which means so 589,038, sorry, 589,038 into 6.5 divided by how much is the life? 13 years. So let's see 589,038 whether it matches. So this into 6.5 divided by 13. So 294,519. Sorry, 6.5. Sorry. So it has to be on the yeah. So the fair value which was arrived was 309,245 in the illustration, and in a way we concluded that valuation of plant and machinery is possible. Accurate valuation is depending on the appropriate standard and approach that is to be followed by the valuer. Secondly, consideration of all depreciation forms, and thirdly, judgment of a qualified and independent valuer will matter a lot while valuing a particular plant and machinery. And the whole purpose of valuation will be will deliver us well supported credible opinion of asset value as such. Then we saw the short question and answer summary. First was about explain the three standards of value: fair market value, fair value SC, and fair value statutory. How does the valuer determine which standard to use? So a fair market value was the price agreed upon in an open market between willing buyer and seller. Fair value as per ASC 820 was the exit price in an orderly transaction between market participants at the valuation date. And fair value statutory is a value defined by laws or regulations, often for tax or legal reporting. Then we saw that valuer's choice depends on purpose of valuation, client's requirement, and applicable regulatory framework also. Break down the three general approaches to value. How does the valuer decide which to use? The cost approach includes value based on cost to construct or replace the asset minus depreciation. Direct market or sales comparison approach includes based on sales of similar assets. And income approach is based on assets income generating potential. However, the approach selection depends on asset type, availability of data, uniqueness of the asset, and the valuation purpose also. Then in question number 3, how cost approach is used for appraisals is discussed. And the formula is current replacement also is equal to cost, purchase cost into current index divided by index at purchase. Depreciation is equal to replacement cost into 1 minus scrap value into age divided by life. So that's what the difference is. Yeah, that's the 279 794. So in this case it's 589 038 into 1 minus 5%, that is 95%, into 1 into 1 minus 5% into used life divided by full life 13. Sorry. Then in question number 4, explain functional obsolescence and impact. There we saw that functional obsolescence refers to loss in asset value due to inefficiency or outdated technology, and this functional obsolescence in a way reduces market appeal and usable value, leading to lower valuation per se. Then in question number 5, economic obsolescence was discussed with an example. Here it refers to external factors reducing asset value. Example, increased raw material or labor cost, and secondly regulations. Example, a new pollution law makes older machinery non-compliant and therefore decreases its utility and value also. Then in question number 6, it was discussed that which method is used for valuing unique machinery with no market competitions or comparisons and why. Cost approach is most appropriate because it does not rely on comparable sales estimates based on rebuild costs adjusted for depreciation. Critically analyze the income approach for machinery and equipment valuation. Why is it least used? So that's a 7 short question and answer which is discussed in the study material. Now in this, if one has to analyze the income approach, typically the income approach relies on assets income generating capacity. It is not preferred because attributing revenue to a particular individual machine is very complex or rather impossible also at times. And thirdly, it is useful for cross-checking other methods when income data is traceable. So this is the critical analysis of the income approach. Then question number 8 was about identifying the 3 types of depreciation and their impact. So physical deterioration means wear and tear and reduces the functional life. Functional obsolescence includes technology as well as design inefficiencies and reduces competitiveness. Economic obsolescence is all about external economic factors and lowers utility and demand also. Then in long question and answer, there was a case which was given wherein machinery purchases of 10 lakhs with 6 years ago, 15 years of life, index at purchase was 100, current index is 154, 10% scrap value, and therefore how to calculate fair value. Step 1 is replacement cost, which is 10 lakh into 154 divided by 100, that comes to 15 lakh 40,000. In step 2, depreciable cost is to be calculated, which is like 15 lakh 40,000 into 90%, because that's the 10% is the scrap value. So 13 lakh 86,000. And step 3 is accumulated depreciation. So 13 lakh 86,000 into 6 divided by 15, that is equal to 5 lakh 54,400. And therefore step 4, which is the fair valuation, is the replacement cost, that is 15,40,000 minus accumulated depreciation, that is 5,54,400. So the fair value is 9,85,600. Differentiate between physical deterioration, functional and economic obsolescence. In that, physical deterioration means wear and tear, aging or environment related loss of value. Functional obsolescence includes internal inefficiency, outdated design or lack of features, and economic obsolescence includes external market and economic factors at the same time which reduces the asset utility. Third question, long question answer, discussed considerations when using direct market comparison for M&E valuation, which includes recent sale types, recent sales data, ensure data is up to date and market relevant. Asset comparability, it adjusts for differences in age, utility and condition. And market activity, typically validate it if there is an active transparent secondary market. So these are the considerations that are to be factored when direct market comparison is being used for valuation. Fourth long question and answer, dealt with impact of functional obsolescence after new machinery installation. So of course, older equipment becomes redundant or shelved also. Loss of utility or relevance leads to rapid devaluation. Likely non-usage further accelerates the deterioration. Fifth question dealt with advantages and disadvantages of income approach in machinery and equipment valuation. The advantages are that it reflects the true earning potential of a particular plant and machinery, and secondly, useful when machine income contribution is measurable individually. However, there are disadvantages because it's hard to link income to a specific asset, and at times it involves complex assumptions about future income in the income approach. Sixth question was about proposing a method to value diverse asset collection with varying lifespans. So a stepwise approach has been proposed. So step 1 includes categorizing assets by usage type or lifespan or some criteria in the diverse asset collection. Second step would be apply cost approach to estimate current replacement cost. Step 3, adjust each asset for physical depreciation based on age and use. Functional obsolescence compared to new tech. Economic obsolescence, which includes market trends and cost. And step 4, which is typically aggregate adjusted values to compute total collection value. Justification to that is ensures each factor impacting value is accounted for systematically. So with this, in a way, we end the chapter. We come to an conclusion of the chapter per se, and we'll stop for the day and for this session in a way. See you in the next session with a new chapter, which is 8.2, and that will be a different asset altogether with specific methods that are required to be followed for valuation for that particular asset, and so on and so forth. So stay tuned. Signing here of CACS Pushkaraj Vishnu Joshi. See you in the next session now. So this is the chapter index. So next chapter or next session will be about valuation of inventory. So let's see what is stored in that. Signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session. Thank you.